A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
It might be over for you and me. With the shutdown of Silicon Valley Bank, there's little hope in sight. I'll tell you why. The plan has already started. This unprecedented fall is expected to cause a banking crisis within and outside the US. This monumental failure sends shockwaves across the technology and science industry. How? Many of those companies are the bank's customers. But that collapse is not just the largest US banking failure since the 2008 financial crisis and the second largest ever, but the start of a master plan to wipe out the financial freedom we know today. Let me explain. The SVB describes itself as a go-to banking partner for investors in the innovation economy. It serves technology and venture capital companies, including many famous brands like Shopify, Pinterest, ZipRecruiter, and crypto companies like BlockFi, Circle, Avalanche, and Ripple. But why did the almighty SVB collapse? It suffered a loss after technology and stocks lost value last year. This condition was also worsened by the Federal Reserve's plan to increase interest rates to combat inflation. Let's go back a bit. In 2020, the tech industry flourished. Many people worked remotely and tech companies were on a hiring spree. By the first quarter of 2020, SVB had $60 billion in customers' deposits. By the end of the first quarter of 2022, it had $200 billion in deposits. It needed to do something with the money. Therefore, it purchased billions of dollars worth of bonds with customer deposits. While it is normal for commercial banks to buy bonds with customers' money, something was wrong in this case. The value of their investments fell because they paid lower interest rates for them compared to what they would pay if they were issued in the new higher interest rate environment. SVB sold a $21 billion bond portfolio consisting mainly of US Treasuries. They expected a 3.9% return, but the actual yield was 1.79%. This act forced the bank to report a loss of $1.8 billion. As the Federal Reserve increased interest rates, the value of SVB's Treasury bonds is expected to fall. It tried to raise capital through investors but didn't find any. As of Friday morning on March 11, 2023, SVB was in talks to sell itself. Even Elon Musk tweeted that he might buy it. By afternoon, the Feds got wind of it and placed its asset under the control of the Federal Deposit Insurance Corp. The FDIC announced that it would sell SVB's assets and payments may be made to uninsured depositors. Most of the deposits were over $250,000, which is not covered by insurance. As normal as it could be, shares plunged by 60% on Thursday and Friday. And now, here's the fun part, so you can understand why regulators intervened. This collapse spelled doom for the crypto industry. What does this mean for the cryptocurrency industry, you ask? Let me explain. The Federal Reserve plan for the cryptocurrency industry's failure also helped facilitate SVB's death. Shortly before this bank's collapse, Silvergate announced it would close and liquidate its assets. Both banks were one of the most crypto-friendly institutions with numerous clients in the industry. Cryptocurrencies are now feeling the heat of SVB's exit. Circle, a stablecoin issuer, noted that it had $3.3 billion in deposits at the bank. On Saturday, some traders were swapping their USDC for Tether, the world's biggest stablecoin with a market value of over $72 billion. Tether was not exposed to SVB and traded above its $1 peg. In May 2022, the depegging of stablecoin UST led to Luna's crash. They wiped billions away from the crypto market. Leading digital currencies like Bitcoin fell from $65,000 to $18,000. BTC is yet to recover from the crash. Crypto investors across the globe are panicking, understandably so. Everyone now likes to say it is not the best of times for the crypto industry. From dealing with the aftermath of bankruptcies in 2020 to struggling with a backlash from Washington, the Federal Reserve has since warned against the lack of investor protection from digital assets. These banks were responsible for transmitting funds to and from crypto companies. Also contributing to the pressure in the crypto market is President Biden's proposal for a 30% tax on crypto mining usage. It is indeed a long year for the crypto industry. Are cryptocurrencies really our enemy, or are the banks the ones? Central banks have never been a fan of cryptocurrencies. Therefore, they created a perfect idea. This new idea is expected to bring other cryptocurrencies to zero. Further than that, it will destroy our financial freedom. The US government has a perfect plan for us. They say it is better than Bitcoin and offers additional benefits. Jerome Powell hinted at this when he appeared before the Senate Banking Committee. He told committee members that his ministry does not want to stifle innovation. He recalled that the crypto space was in turmoil in the past year and warned that financial institutions must be careful in their dealings. The Fed had initially issued a heavy warning to banks to watch their backs. It threatened that businesses focusing on crypto might not meet the safety and soundness standards needed in the US and the rest of the world. Powell insisted that the financial sector makes room for stable coins. However, it can only thrive with appropriate regulation. This explains the need for the central bank's digital currency. The Fed has explored the idea of issuing a digital dollar since 2016. The central bank digital currency is similar to stablecoins, but is managed by the government rather than decentralized networks. How a digital dollar will affect currencies like Ethereum and Bitcoin is still being determined. Powell wonders how these coins do not have an intrinsic value, yet have numerous investors. It's too early to judge which coin will be the worst hit when CBDCs start operating. Currencies like Tether have faced penalties for lying about the token's backing. Paxos is also preparing for a lawsuit from the Securities and Exchange Commission over its Binance-branded stablecoin. Last summer, Terra's UST collapsed. It maintained its value via code instead of assets. This was an eye-opener to lawmakers, as it suggested the urgent need to establish specific rules. 11 countries have established a CBDC. 90 others are still researching and developing theirs. Congressman Lynch asked Powell for a timeline for releasing US CBDC. Despite the urgent need for regulation in the crypto industry, Powell admitted that the development is in the early stage. It may take years to evaluate. However, Congress can sanction it so it gets to the public faster. New York's Federal Reserve Bank has experimented with this idea. It tested the possibilities of a digital dollar working among financial institutions. Firms like Citi and BNY Mellon were involved in the pilot program. Like other digital currencies, CBDC improves cross-border payments that are often slow. Rather than go through banks, one can trade directly, provided they share the same standards. There's only one thing the government doesn't tell us. Fortunately, nothing is hidden under the sun. Analysts have dissected the idea of this government-regulated currency and realised that it's similar to fiat currencies. In fact, it will turn out to be worse. How? Let me tell you a scenario, just like all of that conspiracy stuff back in 2020, if you understand me. Republican lawmakers were the earliest government officials to react to the deceit. Tom Emmer insisted that the new currency erodes Americans' financial privacy rights. Digital currencies conceal the identities of traders while granting access to monetary transactions. A central authority means control of the process that happens within the space. The aim of having a cryptocurrency is defeated if there's an iota of government interference. When the government can decide who can access the blockchain, it becomes a fiat currency or something worse. Regardless of how perfect they paint CBDCs, investors consider the risks in unregulated currencies as a lesser evil. These stablecoins offer huge returns on investment and financial freedom, and provide a level playing field for investors. So, here's the catch. The central bank gets jealous of cryptocurrencies and discourages people from investing. It realizes that in the nearest future, fiat money may be undesirable. Yes, innovation is necessary, but how? It goes behind to copy the digital currency model, which it condemns. To make matters worse, it makes itself the boss. Why did we have more people tilting towards digital currencies? Humans wanted more flexibility with spending money. They also needed to protect their investments from high inflation and increased purchasing power. The central bank wakes up any day and implements a hostile monetary policy that affects the value of money. Therefore, holders of fiat currencies suffer for no fault of theirs. So, yes, you're at the mercy of a few people at the central bank. With unregulated currencies, you don't have people with ulterior motives deciding possible outcomes. Let's say CBDC is the handiwork of conventional adults, uncomfortable with change. They'll rather shove the awkwardness down everyone's throat than keep it to themselves. The Feds may have won a temporary war on cryptocurrency. However, it is too early to celebrate. Investors understand the flaws with unregulated currencies, but one thing is sure. They would pay no heed to any government-controlled money. Should crypto enthusiasts be scared? Does the central bank deserve a listening ear with its CBDC? Let us know your thoughts in the comment section. Please subscribe to Incredibler if you haven't already, as we have more juicy content coming your way. See you in another episode.